Hello traders, welcome to Leading Forex YouTube channel, and today we want to talk about the chapter 2 of our book, The Naked Forex Strategy. Okay, and if you are new to this channel, or if this video is what brought you to this channel, I want to suggest to you that we are doing a playlist of a trading strategy which we believe will be a guide to help you develop your own strategy. Or in case you don't have a strategy at all, this can become a basis for a strategy for you, okay? Or this can be a guide to help you trade in the forex market, okay? So in the chapter 1, which was our previous video in this playlist, so if you go to the forex strategy playlist, you will see the first video. You can watch that, and then from there you can jump to the chapter 2, which we are about to begin, okay? But to make it a quick one, let's go back to the misconceptions, because that is what is involved in the chapter 1, okay? The misconceptions, there are two misconceptions that the writer talked about. The first one is the fact that past results do not guarantee future results. So if you have seen a screenshot somewhere and you saw the results coming in so big, and you think that whatever strategy or tools the person is using can become the basis for you to become a successful trader, or can become the basis for which you can also make fortunes, the writer says it is a misconception. Past results do not guarantee future results. Okay, so that is misconception number 1. The details are in the chapter 1, which I'm sure when you watch the video or our previous video, you'll get details. Okay, so misconception number 2, the writer says that he wouldn't call this a lie, but it's a bit of a misconception, and that is the fact that people think that you need to win most of your trades and lose just a few in order to become successful. And this also, he says, is not true. Okay, it is not actually a fact. And he made his point by saying that a lot of traders on the Wall Street actually lose most of their trades, but before the year ends, they turn out to become profitable. So his idea here is that you don't need to win more trades or most of your trades in order to come out clean as a profit trader, but you can win less and still turn out to be a profitable trader. That is the second misconception our writer talked about. So if you watch the previous video, which is in this playlist, the forex strategy playlist, you will get the details of the misconceptions. Okay, so let's move to chapter 2 of this book. Okay, now the chapter 2 says the naked chart. A few months before this book, I was sitting in on a webinar. The image below is the screen that was shared before me of the trading strategy that they were advocating. Again, I couldn't make heads or tail of what they were trying to say. You have hundreds of different indicators on here: stochastics, moving averages, Bollinger Bands, and the like. I have a feeling this is what most traders' screen look like, where they are looking at very short-term trading time frames, whether it be a 5, 10, or 15 minutes chart overlaid with many different indicators. So let's see the screen. So this was the screen he was exposed to as a strategy when he joined a webinar. So in the webinar, this was what he was exposed to. And quickly, he left the trading room or the webinar. He discontinued with it. He didn't continue with the webinar because what he saw was something terrible to him. So let's look at details, okay? I'm sure most of us have similar charts like this or screens like this, okay? So let's continue. Whether this strategy could make money or not, I had to disengage from this webinar just because it was giving me a headache. Below is an image of what I look at. It is a simple clean chart, which is also referred to as a naked chart. The reason it's called a naked chart is you will notice there is no indicator or no indicators on this chart whatsoever. There is no a moving average, there is no a stochastic, and there is not a Bollinger Band. All I look at are bar charts with the high, low, and close. I look for very simple trends or very simple patterns based on this naked chart that you will see in front of you. This is what I mean by a bar chart. So let's look at the chart. So this is the chart. This is a bar chart. And those of you who are familiar with the MT4 or MT5, we have 3 different kinds of charts which you can switch to. We have the candlesticks chart, we have the linear chart, and then we have the bar chart. And this is the bar chart. Okay? So people trade with different charts. There are people who use the linear charts, and most of traders in the forex market use the candlesticks chart. But this trader is saying he uses the bar chart. Okay? Good. Then doesn't mean that the others are not good. Okay? The candlesticks, the bar, the linear are all good charts depending on how you trade. Okay? Simply, this is what he looks at every day. That's how I want to put this. This is a clean naked chart which he looks at anytime he wants to trade. Be it a candlestick chart, be it whatsoever. It's just a clean chart like this. So if you want to trade with candlesticks chart, according to our writer, he says your chart must be clean as this one, with no indicator, nothing on it, just clean chart like this. Let's continue and find out why. All I look at are bar charts with the high, low, and close. I look for very simple trends or very simple patterns based on this naked chart that you see in front of you. This is what I mean by a bar chart. It simply represents the low to the high of one daily session. For my methodology, as you will come to understand, it's very important for me to see where a market closes relative to the high or the low of the day. Some people like to look at OHLC bars, which is the Olik bars. It's exactly the same, but it includes where price opened for the day. I am not particularly bothered about where price opened, especially not in the forex market. There is so much liquidity that price is pretty fluid. So let me explain what he means by the OHLC bars. That is the same as the candlesticks bars. So our writer is saying that some people like to look at the candlesticks bars, and it is exactly the same. So whether you are using the candlesticks or you are using the bar sticks, according to him, it is the same because they all include price opened for the day and then when price closes. So don't be bothered if you are using candlesticks or bar sticks. Any of them is the same. All right, so let's continue. So this is the bar sticks he talked about. This is just one of them. So let's look at the details. So with a bar stick like this, you have the low of the day, which is at the bottom. The low of the day is actually if the trend is an uptrend. Okay, so let's look at the low of the day, the high of the day, and then where price was at the close of the day. So you see these 3 different things on the bar: the low of the day, the high of the day, and then where price was at the close of the day. So that is how this candle is formed if you are using the bar chart. And simply, if you are using this bar chart, the blue bar simply means it is an uptrend. So the down is the low of the day where price began, and then price went as high as the high of the day, but later dropped to close around the neck, which is where the price at the close of the day. So this tells you that the trader is actually using daily time frame. All right, this should tell you that our trader is using a time frame known as daily time frame. Okay, so this is a bullish candle or a bullish bar, depending on what you use, whether you are using candles or you are using the bar. So bar chart, this will be a bullish bar. If you are using candlesticks, this will be a bullish candle. All right, so let's continue. Now, by closing at one end of the bar or the other, it denotes who won the day. So if you look back at this candle or this bar, who are the winners of the day? It is the buyers who won the day. Is that okay? Good. So let's continue. In the blue bar above, the buyers were in control of that day. Below is an example where the sellers won the day. The market started much higher, eventually fell much lower, and then closed towards the low part of the day. Everything is the same except where the close is. You have a high, low, and close, but this time the close was the lower. So the close was the lower end of the bar. This represented that the sellers were in control of the day. We will be looking at a lot of charts and I will be clarifying this as I go on. So this is the sellers winning the day. So this is a bar and you see it red, meaning that the sellers won. So the high is where the price began and then it fell and then closed, as you see, just around the neck of the lower part. Okay, so this is a sell bar. All right, let's continue. Now, chapter 3. This is where I want you to pay attention. Now, the face of the market. Our book here says that the very first thing the trader will look at when he wants to trade or place a trade in the market is he will look at the face of the market. The face of the market. What face is the market? Before you enter into the market to trade, you need to know what face it is. Okay? So the first step of my trading strategy is defining the face or the condition of the market. At any given time, I have a trading terminal with about 30 different instruments that I look at. I also look at gold. I look at crude oil. When I'm going through my charts at the end of each trading day to determine whether or not I have a trading opportunity, I look at the face to determine whether or not there is a good risk to reward. We will get into that soon. But first, let's identify the face. Typically, you have heard that there are 3 phases of the market. The market can either be going up, it can be going down, or it can be going sideways. So the screenshots about in the middle tells you the kind of phases you've been told. Okay? So we have the uptrend, the downtrend, and then sideways market. So these are the 3 phases you might have heard. Okay? Look at them well again. The up, which is the point number 1. The first chart is the up phase, which means the market is in a buy trend. The 2 is a downtrend, and then the 3 is a sideways. The market is just chopping sideways. So these may be the 3 you know, but the book is going to expose us to additional 2, making 5. Is that okay? So let's continue. But I would like to add a couple other nuances. In my mind, there is also 2 other trading conditions that are very important. One is where the market has been trading down and then all of a sudden, out of the blue, it just turns around and goes the other way. This is actually where I think I have a tremendous strategic edge. Pardon me for my minor errors, okay? Please. Being able to dictate a turn or a change in the market very, very early. I don't confine myself to being a swing trader, a reversal trader, or a trend trader. I don't like to put any kind of definition on what I do. But in the end, most of the money is made on these big turns where the market just reverses from one direction to the other. Although it catches a lot of participants by surprise, if you look closely, the market has a way of indicating when it wants to make these turns. We will drill down to these in a minute. So these are the additional two he wants to add. So the phases of the market, we now have 5. So the first phase, he talked about an uptrend. The second phase, he talked about a downtrend. The third phase, he talked about a sideways market. And then the fourth one is turning from down to up. So you can see the market was going down, but along the line turned and made its way back up. And then the fifth one is turning from up to down. So the market was up, and then quickly it turned and made its way down. So you now have 5 phases or conditions of the forex market. So let's go back again and look at the first, second, and third. So these are the first 3: up, down, and sideways. Up, down, and sideways. And then we have the other 2, which are the turning from down to up, turning from up to down. So the 4 and 5. Now, look at these phases well. If these are the phases as a trader he needs to look at before making a decision, I want to take you back again and give you an assignment. Now, in the comment section, I want to ask you this question. And this is the question. Look at it closely. Okay? Look at this question closely. What phase of the market is this chart right away here? This is the naked chart you are seeing. This is my assignment. What phase of the market is this? Is it an uptrend? Is it a downtrend? Is it a sideways trend? Is it a trend where the trade is going up but it's about to turn and go down? Or this is when a trade is going down but it's about to turn and go up? So these are the 5 phases this book has exposed us to on daily time frame. So I want you to help me in the comment section. Just write what you think is the answer to this question. What phase of the market is this chart? What phase of the market is this chart? Okay? Write your answer in the comment section below. All right? Now let's go back to the phases so that you look at them again. Look at them here. The up, down, sideways, and then the third and fourth is here, or the fourth and fifth. Turning from down to up, turning from up to down. So the turning from down to up means that the market was bearish. A bearish market is a downwards market. So the market was bearish, and then it turned and made its way back bullish. The fifth one, the market was bullish. It turned and made its way down bearish. But the 1 and 2, the number 1 is a bullish market. The number 2 is a bearish market. Number 3 is a choppy market, sideways. All right. So look at the chart again. There's the assignment I have just given you here. Look at it again and tell me what phase you are seeing. What phase of the market is this? Can you identify that? Good. If you can, write your answer in the comment section. Let's continue. Let's just finish the 3rd chapter and then end this video. If you like what you are seeing so far, please subscribe to this channel, okay? I'm your admin, Kofi, of Leading Forex YouTube channel. So let's look at the end of this video for today's episode, okay? Now let's conclude. We are almost done. This part of the strategy is fairly simple. Where is the market going? Is it going up? Is it going down? Is it going sideways, or it is turning from bullish to bearish or bearish to bullish? This is the question. So chapter 4, the historical precedent, will come there in our next video, okay? That will be our next video. But today's video, we saw the phases or the market conditions. If you pick any currency pair, you should be able to identify any of these 5 phases or conditions, okay? Whether it is the number 5, number 4, or it is the number 1, 2, and 3, which is this. Please, apart from identifying the assignment I gave you, also make sure that you go onto your chart and identify the phases of the market using the currency pairs you have. Just take any pair randomly and tell yourself what phase of the market it is. It is very important. Okay? So, once again, my assignment. What phase of the market is this? Please, I need your answer in the comment section. What phase of the market is this? Is it 1, 2, 3, or the 4, or the 5? Give me an answer. And if you have anything else to ask or say, you can put all up in the comment section. Thank you. This is your admin, Kofi of Leading Forex YouTube channel. I'll see you again in our next episode, which will be the chapter 4. All right? Take care and be good.